Imagine buying the safest asset on Earth, holding it for a decade and actually losing money.
Yeah, I mean, it sounds completely impossible.
Right. But get this. Last year, nearly 15% of people who sold prime London real estate did exactly that. Welcome to today's deep dive, where our mission is unpacking a really jarring report from the negotiator.
It is definitely jarring. I mean, for generations, a brick-and-mortar townhouse in central London was, the ultimate financial fortress. You buy it, hold it, and it just protects your wealth.
Okay, let's unpack this, because the core rules of wealth building seem to be actively changing beneath our feet. We need to figure out why wealth managers are suddenly branding London property a high-risk investment.
Yeah, and the data driving this shift is wild. It comes from Hamptons, looking at their 2025 sales data.
15% selling at a loss is just staggering.
Exactly. And coupled with that, there's a severe warning from Simon Basharan over at the wealth management group Rathbones.
Oh, what's he saying?
He's basically advising that prime London homes can no longer serve as the low-risk cornerstone for high net worth planning.
I kind of have to push back here, though. I mean, interest rates are historically high right now, right?
They are, yeah.
So aren't people just bad at timing the market? Like maybe they got caught up by expensive mortgages rather than the housing market itself being fundamentally broken. It feels like buying a famously indestructible car, but just driving it at the wrong time and the wheels fall off.
What's fascinating here is that Rathbones explicitly points out this isn't just some cyclical dip. The vulnerability is actually structural.
Wait, structural how?
Well, the asset exposes owners to three core vulnerabilities. First, there's severe concentration risk, since you're putting all your capital into one, immovable object.
Right, making it super illiquid.
Exactly. Illiquidity is the second major issue.
Yeah.
And third is a rising, really punitive tax burden that just drains its value over time.
Ah, the tax burden. Here's where it gets really interesting, because how do higher taxes translate directly to a realized 15% loss for the seller?
It all comes down to buyer demand and those carrying costs. I mean, the government has introduced higher stamp duty surcharges, right?
Yeah.
And they're debating a new mansion tax, plus adding high-value council tax supplements. So the annual cost of just holding the property skyrockets.
So buyers are factoring in those future costs and just refusing to pay the original asking price.
You nailed it. If you need to sell, your only option is to slash your price to compensate the buyer for taking on those future taxes.
Oh, man, so it's less like owning a secure vault and more like trying to exit a crowded theater where the exit doors shrink by 10% every year.
That's a great way to put it.
It's like winning a luxury yacht on a game show, only to go bankrupt paying the mooring fees and taxes.
Right.
You're just trapped.
And the report notes this trap gets even tighter when it comes to estate planning. This is actually the most critical warning from Basharan.
Oh, right, the inheritance issue.
Yeah, so if you hold a diversified portfolio of active businesses, they often qualify for business relief, which shields them from inheritance tax.
So passive residential property doesn't get that exemption, right?
Exactly. The entire value flows directly into your inheritance tax calculations.
Wait, so if property values naturally inflate over decades, but the government has frozen the inheritance tax thresholds, the math gets incredibly ugly.
Extremely ugly. The tax-free allowance stays completely flat while the house price doubles.
Silently dragging middle-class wealth into a massive tax bracket. That is terrifying.
If we connect this to the bigger picture, you see the mechanism of a distressed sale. A family inherits a multi-million-pound home, but they don't inherit millions in liquid cash to pay the tax.
So they're forced to sell immediately.
Precisely. And add in that shrinking buyer demand we just talked about, with those slow sales processes and volatile valuations, they end up accepting a huge loss just to clear the debt. Escaping this trap is incredibly difficult.
So what does this all mean for you listening right now? I mean, as an experienced podcast host, I see financial trends come and go, but this really proves the set-it-and-forget-it era of investing is dead.
It really is. Relying on a single asset class, no matter its historical reputation, is a massive vulnerability when structural and political winds shift.
Even if you aren't sitting on a prime estate in Mayfair, property must now be just one slice of a heavily diversified plan, not the whole pie.
100%. You cannot just rely on bricks and mortar anymore.
Which leaves us with this to think about. If prime London real estate, long considered an invincible financial fortress, is hiding this level of structural vulnerability, what other universally accepted safe investments in your own portfolio might actually be a ticking tax bomb?